So there are hundreds of different approaches investors use when taking on the stock market. Different strategies are each informed by different philosophies and different ways of thinking. As an investor, it's important to have an approach to guide you into the future. So, here are 6 popular strategies that are relevant for 2021 with examples. So stay tuned until the end where I reveal my favorite strategy. If you're new to the channel, please give this video a thumbs up, which does really help, and hit subscribe if you're interested in seeing more content like this. Also, I'll be replying to your questions, so feel free to leave them in the comment section below, and I'd love to hear your thoughts on this topic. Heads up, this is not financial advice. The information in this video is general in nature only. Strategy number 6, value investing. Starting with probably the most well-known strategy out there, value investing. This is where you buy stocks that are undervalued to hold for the long term, also known as the buy and hold technique, famously used by some of the best investors in history, Warren Buffett and his mentor, Benjamin Graham. This strategy is all about finding the best bargains by analyzing company fundamentals. So that means buying stocks at a discount and selling later for a higher price. It seems simple enough, but because the stock market is super volatile, in order to make the strategy work, you really need to be in it for the long haul. You do it by looking at company fundamentals to try and predict where a company will be in 10, 20, or 40 years' time. One of the most popular fundamentals is the PE ratio, or the price to earnings ratio, which compares the price of a stock with how much the company is earning. There's a lot more to it, but essentially a high PE ratio indicates a company is overvalued and could soon crash. And a low PE ratio indicates the opposite, that the market has undervalued the company and it could be a good buy. Unfortunately, it's not so clear cut, because a high PE ratio can also mean that the market is extremely bullish about its future prospects rather than its current financial state. The short of it is that the PE ratio only shows us how the company has performed and very little about the future. Other fundamentals include debt to equity ratio, forward-looking growth plans, and what it plans to do with any profits. So why is this a good strategy for 2021? Well, it's a good question. Many would argue that we're currently in an overvalued market because so much money has poured into the stock market since the start of 2020 to 2021. Stock prices have since risen far more than company earnings have. But that doesn't mean you can't keep an eye out for bargains. With so much volatility in the stock market, it pays to keep an eye out for any opportunities if stocks do come crashing down again, as we saw it in March last year, and as some analysts are predicting. Some good examples of blue chip value companies where you might try to buy the dip include Berkshire Hathaway, Apple, Microsoft, and Coca-Cola. Strategy number 5. Growth investing. This strategy is sometimes viewed as the opposite of value investing, although there are a bunch of similarities which I'll go into. Growth investing is about looking for high future growth. Unlike value investing, you're looking for stocks that have strong potential rather than assessing its current performance. So the company might not be earning a profit now, which means it's not a good value stock, but investors are looking for fundamental signs that the stock will bring in huge profit down the line. Tesla is a great example of a growth stock, which up until recently was not profitable. But investors believed in the vision that Tesla would at some point dominate not only EV vehicles, but also electric storage. But because it had not been delivering profit, it would not be considered a value stock. Growth stocks often have lower valuations by analysts, and they might only just be starting out, which means they tend to carry a higher amount of risk. We're betting on something that hasn't yet happened. Why is it good for 2021? Well, this strategy has dominated 2020. The market was led by huge gains in digital technology stocks, many which up until now have reported zero or low profits. Good examples of growth companies that have seen huge gains between 2020 to 2021 include Zoom, Tesla, Alibaba, Neo, Slack, and Netflix, among many others. Strategy number 4. Buy high, sell higher. Unlike the buy low, sell high strategy, this one is about chasing the upward trend. So instead of buying when a stock price has fallen, another method is to buy in as prices are rising and then sell when prices start to fall. This might sound like the opposite of what you should be doing, and value investors would agree, but plenty of active traders stand by it. The idea is that you buy a stock as it's rising and then set a type of limit order to sell the same stock at a price above what you bought it for. So you can still make a profit by riding the short-term price trend, even if prices crash soon after. But this strategy does mean you need to have an understanding of conditional or limit orders and a platform that offers them, because not all trading apps do. Conditional orders allow you to set buy or sell instructions depending on price movements. For example, say Tesla's price is quickly rising. You could set a buy instruction at say $800, along with a trailing limit order to sell it once it hits $805. But only if its price starts to fall by a certain percentage below that point. So that means that if Tesla stock continues going up, you won't sell. But you also won't lose more than what you initially invested. There's a bunch of different names for conditional orders, and brokers call them all different things. But some of the most well-recognized are stop loss, take profit, trailing orders, and the market order. This can also be a risky strategy if you're not an experienced investor, so be warned. Why 2021? Well, the last 12 months have been the most volatile in history for the stock market, which is actually great news for active traders that are looking to make short-term gains. Strategy number 3, index fund dollar cost averaging. This is where you're buying into a broad market index fund. It's a long-term strategy which reduces risk by spreading out your investments into regular periods, for example, monthly or weekly. If you do this for a long enough period of time, it will significantly lessen the impact of any corrections or market crashes. So say for example you'd invested $500 a month into a Vanguard index fund, which has seen an average return of 8% every year for the last 5 years, minus say a brokerage fee of $5, well after 5 years you'd have seen an unrealized profit of $6,371. Now while this strategy does lower your risk, the trade-off is that it also tends to come with reduced returns as compared to investing all of your money at once. This is because the market tends to go up more than it goes down, historically. So if you invest small amounts over the long term, you would not have exposure to as much gain as if you'd bought it all at once. According to a 2012 Vanguard study, investing all of your money at once would historically have produced better returns than dollar cost averaging about 66% of the time, while accepting a lower return may be the reality for most. The range of benefits of the strategy are pretty compelling. Why is it good for 2021? Well, if stock market volatility this year is like anything it was last year, then dollar cost averaging can be a very good strategy to use because it takes the emotion out of investing by investing a set amount at set intervals, say every month or every week. Strategy number 2, thematic investing. This is where you're trying to invest in a trend. For example, socially responsible investing, clean energy, or cloud technology. So say you believe that the future of motor travel is in electric vehicles. You could focus a part of your portfolio on electric vehicle stocks like Tesla or NIO or even lithium miners. Alternatively, you could invest in this through an exchange-traded fund. An ETF is a listed investment fund that holds hundreds or even thousands of company stocks. Many of these are themed ETFs, such as Asian stocks, US stocks, or technology stocks. You can even get an electric vehicle ETF and cannabis ETFs. So say you buy a global cannabis ETF, you're investing in a whole portfolio of cannabis stocks from around the world. Or you could invest in an ethical ETF, which holds a list of stocks that meet certain ethical criteria, like no child exploitation or carbon emissions. Why is it good for 2021? Well, some industries and themes stand to benefit more than others moving forward. For example, electric vehicles, ethical, and yes, cannabis. Now for my favorite strategy, income investing. Okay, yes, you can make money from capital gains. The other way is through dividends. This strategy is called income investing. This is all about building up a passive income in the long term. Dividends are a percentage of a company profit, so some major companies choose to pay profits to shareholders instead of spending on company growth, making it the opposite of a growth strategy. The idea of it is that if you have a big enough dividend portfolio, you may never have to sell your stocks. In some countries, such as Australia and the UK, you get tax benefits on dividends if you're in your retirement phase. So if your dividend stocks remain in a family trust, it can be built up and passed down through generations. This makes dividend investing an attractive strategy for long-term investors. So why is it good for 2021? Many companies have scrapped or reduced dividends over the last 12 months to cope with the challenges of COVID-19. At the same time, with bank interest rates near zero, there are little other options for income investors looking to earn a regular, steady cash flow. Dividend stocks might be harder to find these days in the more traditional companies, such as the banks. But at the same time, newly formed dividend payers in the tech space are joining the ranks. And who knows, we might even see the likes of Apple or Google sit among the dividend kings as we switch to the new economy. Okay, so to sum it all up, there are a bunch of strategies out there for 2021, and it will be interesting to see which strategy wins out from here. So what do you make of these stock market strategies? Which one do you think will win out over the course of the year? I'm always keen to chat further with you, so make sure to leave comments in the section below. If you've got something out of this content, please give this video a like and subscribe to the channel. This helps us grow and it brings you more content like this. Anyway, that's it for now. Thank you for watching and we'll see you in the next video.